Okay, good morning and welcome back to the box, Mills and Reeves webinar series for insurance brokers, intermediaries, and their insurers. For those who don't know me, I'm Liam Burnett and I head up Mills and Reeves National Broker Practice. And I'm joined this morning by my colleague, Tim Hornby. Good morning, Tim.
Good morning, Liam, and good morning to everyone joining.
So before we begin, a couple of bits of housekeeping before we start. So firstly, this webinar is recorded and you will receive a copy of the recording after the event. It will also be uploaded to our YouTube channel where you can catch up on all previous editions of the box. Secondly, if you have any questions as we're going, then please do type them into the Q&A function at the bottom of your screen and we will do our best to pick them up at the end. So the question that we'll be answering this morning is whether the Insurance Act has made brokers a better E&O risk. Well, the Act has certainly had an impact, but it's not the only reason that brokers are a better insurance risk in our view. Since the Act was introduced in August 2016, there have been significant developments in this sector. Firstly, private equity investment over the last 10 years has driven a really busy cycle of consolidation. And some of the largest insurance brokers in the UK, the likes of PIB and Global Risk Partners, now part of the Brown & Brown Group, didn't even exist 10 years ago. And as a result of that, we are dealing with a smaller pool of brokers, but they tend to be much larger businesses with significant funds to invest in training, risk management, and regulatory compliance. And the competition for businesses in this sector is at the strongest of all time, especially now where there is a really increased focus on the customer journey and delivering value to clients. Increased regulation is another factor. So the landscape has changed. And we had the introduction of the IDD in 2018. We now have the new Consumer Duty. The Financial Ombudsman's powers are ever increasing. And we have the FCA really focused on consumer protection and putting the needs of the client first. So all of these things in combination have raised standards across the sector. However, what the Insurance Act has done is increase the burden on insurers to explain, evidence, and justify any coverage decision that they take to avoid or reduce their liability to meet a claim. And as a result of that, we find that the policyholder and often the broker supporting their client will more readily challenge a declining insurer's position at a much earlier stage. And the cases that we're about to talk about this morning emphasize the importance of taking that step, but also just how the Insurance Act has leveled the playing field between policyholders and their insurers. And this is another further reason why we think insurance brokers have become a better E&O risk. So the first case that I'm going to talk about today is George on High Limited versus Alan Boswell, insurance brokers in New India. Now, this is not a rerun of the session that my colleagues James Thompson and Shay Williams delivered at the end of last year, and you can watch the recording of their episode on our YouTube channel. However, the key points arising from this decision and what I really want to focus on today to answer this question are as follows. So, the facts. The case concerned a 16th century boutique hotel in Rye, which is in Sussex. The first claimant, George on High Limited, owned the freehold of the hotel. The second claimant, George on Rye Limited, owned and operated the hotel business and the restaurant. And importantly, George on Rye paid rent to George on High for use of the premises. Since around 2013, the broker, Alan Boswell, placed property insurance and BI cover for both businesses with New India. In July 2019, the hotel suffered a catastrophic fire and it was unable to trade whilst renovation works were being carried out. And a claim was made to New India. So claim 1 was made by George on High for losses caused by damage to the building. Claim 2 was made by the trading entity, George on Rye, in respect of business interruption losses. Now, the schedule to the New India policy named the insured as the George on High Limited, trading as the George in Rye. As a result, New India refused to pay George on Rye's business interruption claim because it claimed it was not an insured and did not have an insurable interest in the policy. George on Rye sued their broker. The broker, Alan Boswell, then joined New India into the proceedings based on their belief that the BI claim should be paid. Now, whilst there were other issues in play in this case, including potential underinsurance problems, and I won't go into those today, the judgment is really important to establishing what facts an insurer is deemed to know, or what facts an insurer is deemed to ought to know when it comes to fair presentation. So in this case, the broker failed to make it sufficiently clear to underwriters that there were two businesses here, different legal entities with different roles and interests that were both to be insured under the same policy. However, New India had devolved all responsibility for claims to a third-party agent under a TPA arrangement. And the court had to consider whether information that was shared with the TPA was information that New India was deemed to know or ought to know within the meaning of Section 5 of the Insurance Act. And the key information is shown on this slide. So this is what information it was contended that New India knew. Between 2014 to 2016, the TPA dealt with personal injury claims against George on Rye that were made by employees and guests of the hotel. The TPA was aware that George on Rye ran the business and employed staff, and that knowledge was evident from internal correspondence and also from a detailed attendance note of a meeting that took place between the TPA and the hotel operator. The injury claims were settled by the TPA on behalf of New India, and at no stage did the TPA or New India ever question whether George on Rye was insured under the policy. Importantly, George on Rye also paid the policy premium each year. Now, New India argued that it had no actual knowledge of George on Rye's involvement in historic claims, and that knowledge of the TPA should not be imputed to the underwriters. Now, whilst it's unlikely that this claim would ever have got to the doors of court if that information had been disclosed to underwriters at the point of renewal, the court took the view that this was information which, under Section 5 of the Insurance Act, as shown on this slide, was either known by an agent of the insurer who would reasonably have passed on the relevant information to New India, or it was information that was held by New India, by its agent, the TPA, and therefore it was readily available to underwriters. The judge went further to explain that the meaning of Section 5 of the Act is likely to go beyond information simply held by a TPA, and it's also intended to include information that's contained within expert reports that an insurer may obtain from, for example, a surveyor or even a medical expert. And ultimately, this is a decision that in the past would likely have gone against the broker, but it provides clear evidence of how the Insurance Act has levelled the playing field to make brokers, we think, less of a target. The next claim that I'm going to talk about is Hansard 1 and 43 Limited versus AE Insurance Brokers. Now, judgment was handed down in this case in February, but the claim concerns a pre-Insurance Act policy that was arranged in 2014. The decision is important for different reasons, but our focus today is about how and when an insurer waives its right to potentially material information at the presentation stage and what this means in practice. Now, although this was a case considered in the context of the 1906 Marine Insurance Act, the relevant provision around waiving right to information is mirrored in the 2015 Act, and it's shown on this slide. So, to the facts of this case. The broker was instructed to secure a property owner's policy for Hansard. Hansard was a business that owned a sprawling industrial site in the West Midlands. The tenant of the property was a subsidiary company owned by Hansard, and that company was called Inconite, and it occupied the premises under a long-term lease. However, at some point, Inconite went into administration. The property was then damaged by the administrators of Inconite when they removed plant and machinery, and a claim was made by Hansard to its insurer, Fusion, for reinstatement costs and for damage to fixtures and fittings, and the claim was brought for an excess of £1.5 million. The insurer avoided the policy on two grounds. Firstly, the failure to disclose the association of Hansard's directors with prior insolvent or failed companies. And secondly, there was a failure to disclose the fact that the occupying tenant, Inconite, had gone into administration. Hansard sued its broker on the basis that it failed to take Hansard through all of the questions on the proposal form to ensure that the questions given to the answers were correct and accurate. And secondly, because Hansard's demands and needs were not met by this policy, namely because cover was excluded for accidental damage and there was no cover for loss of rent. The broker denied the claim. Firstly, because the broker said the claim was founded on the lies of Mr. Beresford, the owner and one of the directors of Hampsard. Secondly, because the broker denied that there had been a breach of duty. And thirdly, in any event, there was no causative link between the alleged breaches and the losses that were claimed. So moving to the next slide, the key questions that were asked in this case are set up here. The first question was about whether the broker was in breach of duty for failing to disclose the association of Hampsard's directors with prior failed companies. Now, whilst it was common ground that the broker was aware that Mr. Beresford had been a director in 3 insolvent companies, including the tenant, it was disputed as to whether Mr. Beresford's involvement in those businesses was something that should have been disclosed to the insurer. Now, Hampsard's position was that this information should have been disclosed to underwriters in response to the catch-all question at the end of the proposal form, which said, are there any material facts that the insurer should be made aware of? Now, whilst the broker accepted in cross-examination that the involvement of a director with 3 insolvent companies is something that would be of material interest to the underwriter, the broker argued that the insurer was not able to avoid the policy in the event of a material non-disclosure if the insurer had waived its right to receive that information. The broker asserted that the insurer had waived its right to that information in this case by stating on the statement of fact that the policy had been arranged based on the accuracy of a number of assumptions. The key assumption made by the insurer, as shown on this slide, was that you, the proposer, or any named persons on this policy have not been declared bankrupt or are subject to bankruptcy proceedings or any voluntary or mandatory insolvency process. Now, the broker argued that this statement amounted to an assumption about the position of Hampsard and Mr. and Mrs. Beresford personally. And as none of them had ever been made bankrupt, nor had they been involved in any insolvency proceedings personally, the assumption was true for them. The broker argued that having restricted the ambit of the request to such confirmation, the insurer had waived its right to disclosure of further material information that went beyond that request and assumption. As a result, the broker said that it was under no duty to disclose this information or any information about the fact that Mr. Beresford had been a director of 3 insolvent companies. So what did the court decide? The judge formed the view that the question asked on the proposal form and the assumption made was clear, and that the response given to the associated question was correct. Now, if the insurer had wanted to know about information as to whether the insured and any of the proposers had an interest in any other business that had been through an insolvency process, then it could have asked that question, but it didn't. Therefore, the insurer had waived its right to disclosure of further information, and there was no duty on Hampsard or the broker to provide it. Question 2. Was the broker in breach for failing to disclose the tenant was in administration? Now, this was a narrow issue. It was common ground that this was something that should have been disclosed to the underwriters. However, and this is really helpful for defending claims against brokers, the judge found that whilst the position wasn't perfectly clear, Hampsard had not established, they failed to establish that the broker did not provide this information to the underwriters. And because Hampsard failed to demonstrate that the broker hadn't passed that information on to underwriters, it had also failed to demonstrate that the broker had breached their contractual and tortious duties. When it came to causation, the judge also concluded that based on the expert evidence heard at trial, the property was in such a state of disrepair that no other insurer would have offered terms, and that's quite a significant finding. The final question, what about the claim for loss of rent? So this was determined on the facts, because here, whilst it was alleged the broker should have got loss of rent cover, Hampsard was not receiving rent at the date the policy renewed. It also reached an agreement with administrators that they would not pay rent. So the court found that it was never a requirement that Hampsard needed loss of rent cover. It wasn't receiving rent. what's interesting here is, whilst the allegation was not pleaded, Hansard sought permission to introduce a further allegation on the first day of trial. What Hansard wanted to allege was that if the insurer had paid the accidental damage claim, then it would have used that money to carry out refurbishment works. So that's stage one of the argument. It would have got a tenant in, stage two of the argument, and that tenant would have paid rental income of around 1.8 million until Hansard eventually sold the property. Okay. The judge refused the application to amend the particulars of the claim. It was made too late. But helpfully, at the end of his judgment, the judge did conclude that even if the allegation had been allowed, he would have found against Hansard in any event. And that's because consequential losses arising from non-payment of an indemnity are rarely recoverable in brokers' negligence cases. I'm now going to hand over to Tim to talk about the decision in Scott Beef and DNS Storage.
Thank you, Liam. Right, so this is another 2024 decision, this time from the Technology and Construction Court. Scott Beef Limited, a manufacturer of beef-based food products, issued a claim against DNS Storage, a supplier of storage and transport services. The claim was issued after a substantial quantity of meat became spoiled whilst in DNS's care. DNS argued that the Food Storage and Distribution Federation, or the FSDF, contract terms applied. These terms capped DNS's liability for defective meat at £250 per tonne. Scott Beef argued that the FSDF terms had not been incorporated into the contract, and the court agreed. DNS became insolvent and entered liquidation. Scott Beef added DNS's insurers, the Lonham Group, as a second defendant via a claim brought under the 2010 Third Parties' Rights Against Insurers Act. The insurer denied liability on the basis that DNS's failure to incorporate the FSDF terms was a breach of the duty of assured clause in the policy. The insurer argued that the clause, which was a condition precedent to liability, required DNS to contract on FSDF terms. As such, the insurer was not liable to indemnify DNS, and then it follows the insurer could not be liable to Scott Beef. Now, whilst we try to keep to the rule that slides should not contain too much information, the wording of the duty of assured clause here is very important. The full wording is on the slide, and I'll leave it there whilst I discuss the issues. But it reads, it is a condition precedent to the liability of underwriters. 1, that the assured makes a full declaration of all current trading conditions at inception of the policy period. 2, that during the currency of this policy, the assured continuously trades under the conditions declared and approved by underwriters in writing. And 3, that the assured shall take all reasonable and practicable steps to ensure that their trading conditions are incorporated in all contracts entered into by the assured. There was then various examples of what constitutes reasonable and practicable steps to incorporate the terms. The policy then went on to say, if a claim arises in respect of a contract into which the assured have failed to incorporate the above-mentioned conditions, the assured's right to be indemnified under this policy in respect of such a claim shall not be prejudiced, providing that the assured has taken all reasonable and practicable steps to incorporate the above conditions into contracts. That's our emphasis in bold there. Despite the above, 2 pages later and totally in conflict, the policy further stated, the effect of a breach of a condition precedent is that the underwriters are entitled to avoid the claim in its entirety. Scott Beef disagreed with the insurer's position, and the parties asked the court to determine the meaning and effect of the duty of assured clause. This was resolved as a preliminary issue. So the court decided that, firstly, the sub-clauses had to be read together and not separately. The clause itself had referred to the above-mentioned conditions as a collective. Subclause 1 was a representation made when the policy incepted. The policy sought to convert that representation into a warranty, akin to a basis of contract clause, which is prohibited under the Insurance Act. Subclause 2 does not have to be read as a subordinate clause to subclause 1, but it was not relevant on these facts because it referred to trading during the currency of this policy. The breach was the failure to incorporate FSDF terms into contracts that were entered into prior to inception of the policy. Subclause 2 refers to a situation that exists or occurs after inception. This was not relevant because the breach had already occurred. Subclause 3 was onerous because it required the assured to take all reasonable steps to incorporate the FSDF conditions. The court considered the possibility that the assured could still be in breach even if the FSDF terms had been incorporated, but the assured had not taken all reasonable steps to secure that outcome. Furthermore, Subclause 3 was ambiguous and did not pass the transparency requirements of the Insurance Act. On the one hand, the clause says that the assured must take the steps outlined. However, immediately below, it says the assured's right to be indemnified shall not be prejudiced if the assured took reasonable and practicable steps. However, yet again, 2 pages later, the policy states the effect of a breach of condition precedent is that the insurer is entitled to avoid the claim in its entirety. That ambiguity was construed against the insurer. The transparency requirements of the Act were not met generally, as there was no evidence that the insurer had drawn attention to the disadvantageous subclauses and where it had sought to contract out of the protections afforded by the Insurance Act. In conclusion then, as the subclauses had to be read together and subclause 2 could not be read as a standalone condition precedent, the court then considered the impact of subclauses 1 to 3 together in the context of the duty to give fair presentation. It was quickly established that DNS had misrepresented the fact of incorporation of FSDF terms into the contract with Scott Beef. The court quickly determined that this was a breach of the duty to give fair presentation. However, as the insurer did not plead that the misrepresentation was either deliberate or reckless, or, if neither deliberate nor reckless, that it would have contracted on different terms, the insurer had to demonstrate that it would have entered into the contract or would not have entered into the contract on any terms at all. The court concluded that whilst there were certain terms important to the insurer to incorporate, the court was not satisfied, based on evidence given by the underwriter, that the insurer would have refused to enter the contract on any terms. The result was that Scott Beef was able to pursue its claim against the insurer. So the 3 cases we've talked about today represent good decisions for policyholders and for brokers. The very clear message that comes out of these decisions is that no longer can insurers rely on the doctrine of utmost good faith as an absolute or automatic get-out. They really do now need to justify and evidence any decision to avoid or limit cover. The Act means that there is less scope for insurers to reduce or avoid cover, which has helped take brokers out of the firing line somewhat. Further, the duty of fair presentation is clear, and brokers take greater care to advise clients as to the consequences of failing to comply. So, even when the insurer does have a defence to payment of a claim, it is not automatically the broker's fault. That said, the broker's role is to facilitate the transfer of risk from the policyholder to the insurer. Even in the 3 cases we've discussed today, the brokers were far from perfect. That's because the policyholders may say the broker exposed them to an unnecessary risk of litigation with their insurer. So in takeaway, in George on High, if accurate information had been presented to underwriters from the outset, there would have been no need to argue over whether the insurer had the knowledge of the third-party agent. In Hansard, whilst it was considered that the insurer had waived its right to further information, you may rightly ask, well, would it have been better for that information to have been disclosed in any event? That's a very difficult question to answer, and it is an issue that brokers frequently have to navigate. But there will always be a risk if a broker does not disclose known material facts and instead seeks to rely upon the insurer having waived their right to more information. In Scott Beef, this was a poorly drafted policy that may not have been suitable. The issues might have been avoided entirely by a better review of the policy and the broker asking questions to establish what terms the client was contracted on, i.e., better knowing their client and their needs. Although the outcomes of the 3 cases were positive for brokers, there may still have been some irrecoverable costs that the policyholder had to bear. They might therefore still look to recover those from the broker. But the good news, if there was an exposure, it was to a much smaller claim. In George on High, the issues in dispute were all about the insurer's knowledge, but it's important to highlight that the Insurance Act also sets out what falls within an insured's knowledge. If New India was deemed to know information held by a third party, then a broker will no doubt be seized with knowledge held by its own claims team. The message here is to ensure that the knowledge requirements of the Act are properly understood by the broker and the client, so that appropriate inquiries can be made before the policy incepts. Despite the positive developments we've discussed today, errors on this could bring a broker back into the firing line. So while some risks remain, the other factors that Liam mentioned in opening today, such as market consolidation and increased regulation, means that generally brokers are financially equipped to respond to and discharge the regulatory burden. We have seen this firsthand when we are approached by brokers to deliver training or advise on risk management issues. Brokers are far more focused on the customer journey and how to deliver value to them. This is not purely down to regulatory changes and developments, such as in these three cases, but also increased competition between large businesses all competing for market share and access to new and evolving niche markets. Taking these changes into account with the Insurance Act, we think that brokers are now a much better risk for insurers. Thank you. I will now pass to Harriet for any questions.
Thank you very much, Tim. We have just enough time to scupper in one question. The question is this. Liam, you mentioned that brokers should always ensure that they speak to their own claims team to gather information prior to renewal. Is this really always necessary?
It's a good question, but I think it depends how it depends on the approach to renewal. So a lot of the claims that we see that arise from renewal are where the broker takes a pyramid approach. And so what I mean by that is that detailed due diligence is carried out on the client, detailed advice is given in year one, and then each year that the broker returns the client to look at that information again, the questions they ask are, has anything changed? And potentially the broker does not then carry out the work or ask the questions that they may need to ask the client to place this risk. So in those situations, it's really important for the broker to speak to their claims teams, because there's that risk that the claims team has come into information during the course of the year, making notifications or dealing with claims that the broker on the placing side may not capture if it doesn't ask the right questions. So does the broker always need to ask the claims team? No, but it depends on what the approach is to renewal.
I suppose it's a bit like litigation. Good file management and keeping up with your client is paramount, yes?
Yeah.
Well, that's all we've got time for today, so I'll pass the baton back to you to close down, if I may, Liam.
Thank you. And look, if anyone does have any further questions, please do contact Tim or I by email. Happy to pick this up later. Thank you very much for all attending. Before you log off, there will be a feedback form as you do. Please do complete it. It's really helpful to us. Just feedback on the presenters today and presentation style, but also how you might like us to deliver these events in future, whether in person, virtual or hybrid. And please do let us know what topics you might be interested in hearing from us on. Thank you very much for joining. We'll see you next time.